G'day traders, I'm Greg McKenna. Welcome to Markets Morning. It is Monday the 19th of November. Being a Monday, I'm going to look at the weekly charts almost exclusively this week. And strap on in because there's a lot to talk about. Make sure you read the written version of Markets Morning. I'm sure I'm not going to be able to cover everything in this chat here. There's also a US dollar index chart in there I'd like you to look at. There's a quick discussion about the US 10s I'd like you to look at there, and that way we can focus on the stuff that we normally focus on here. Just to recap, two big themes and one more subtle theme that's probably more important than the two big ones are what's driving markets right now. Of course, we've got oil, we've got the collapse, we've got the Khashoggi murder, we've got what the Saudis are going to do, we've got what President Trump's going to do, we've got the CIA apparently saying that the Crown Prince bin Salman was part of it. We've got the President saying, well, I'm not sure about that, maybe we'll never know, kind of equivocating. And then we've got what are the Saudis going to do about oil? While we're below last week's lows, it does look like we could have a bounce, but we'll talk about that. The other big thing, of course, is Brexit. We've got Brexit still going on. We've got Theresa May still in number 10. She's still moving forward. We need to see how that's resolved. Is there a challenge coming? If they've got any gumption, these rebels, they have to do it now, but it also means probably you get a hard Brexit. It's going to be very interesting and somewhat destabilising. I guess I've formed the view that, Mrs. May is trying to do a deal that is least bad for everybody. That means it's not going to satisfy anybody, which is the cause of the strife right now. But the more important thing, the third of the three drivers, is the subtle shift in the Fed. Now, I talked about it last Friday, and I've talked about it again today in Markets Morning. My sense is that in the same way that before the September meeting, we had this shift to hawkishness, now we've got this shift to a bit more kind of, heck, offshore really is slowing. That is going to impact on the US. And the tariffs, if this trade war doesn't get undone, the tariffs haven't even really hit the Chinese economy. We're still at 10%. So we'll keep an eye on that. 223, let's dive straight into charts. It was a bad night for the Nasdaq, a good night for stocks. The US dollar came under pressure because Rich Clarida gave those comments from the Fed, which got things moving. What we're going to do is we're going to do foreign exchange, then we'll do commodities, then we will do stocks as usual, and then we'll have a quick look at Bitcoin. And let's kick off with Euro as per usual. What do you got? You've got a head and shoulders, but you've got a neckline that's held. The inverse is true of the US dollar index, 57%, roughly the same. Anyway, so down here at 112.15. So what do we got? Well, the chance of a euro rally has increased with the break of 113.60 over the weekend. So if I have a look at this, I could easily see the case for a run to, I think I said 115.50 or 40 last week. If you have a look at this, you got 116 is a 23.6, and I haven't even moved that yet. I won't worry about that because it's 80 points, and 40%, of 80, 40% of 80 points is not a lot. So you still get, it's 116.20 or something like that, 23.6, and then we've got 118. So I said jokingly, I'm not saying on Friday, I said jokingly, I'm not saying euro is going to go to 118. But that chance has opened up with this shift in the Fed. The reason it's important, sorry for knocking the table, the reason it's important is because that's the way the market wants to read it. Now, in Markets Morning, the written piece today, at the bottom of the macro bit, I've shared a link to an interview with David Rosenberg from Gluskin Sheff. Now, one of the things when you're an economist or a strategist, and I'm a strategist, I use the tool of economics, but I am a strategist. He said what an economist does is say, how bad are things? And what a strategist does is say, how much of that's priced in? That's my exclusive focus. Yes, I know what's going on in the economy, all that kind of stuff. But when we're talking about trading, we're talking about what's priced in. That's why I talk about the Citibank Economic Surprise Index so often. That's why I made a focus in the written piece, and hopefully, this is a stream of consciousness, so sometimes I don't actually remember what I've said. What I said about the Aussie CC score is plus 23. That's world leading at the moment. No wonder the Aussie dollar's caught a bid. What we've got here, though, in the US is that the Fed is starting to say, well, maybe we need to worry. Why is that important? It's because the market believes the US economy is going to slow. The market believes that the European economy is going to continue to slow. The market believes that China is going to continue to slow. So when the Fed says, oh, maybe we need to take that into account, the market hears they're going to stop. That's important for foreign exchange. That gives euro a chance to rally. It gives everything else a chance to rally too. So unless or until last week's lows break, and of course on a daily basis and that kind of stuff, there's a real chance we go back down and test 113.60 or something like that. 113.30 even maybe. That was last week's kind of, couldn't get through, and then it got to 60, and then it ran. But this is the thing. That's what the Fed is now saying is what the market wants to believe, and we've got a heavily long market, a really heavily long US dollar market. In dollar yen terms, all right, we're still stuck. 114.50.75 is the key for me. You break that, you can run a good 200, 250 points, but it's got to get through. In this environment, is that going to happen if the US dollar is going to weaken a little? Possibly not, but we are looking at this discreetly, aren't we? So what do we got here? 111.52. I wouldn't be surprised to see it back there this week. Sterling and Brexit. What a mess, what a mess, what a mess. But from a chart point of view, it's not a mess, is it? It's not a mess at all. It's a range. 126.60 on the bottom side. The recent low was 126.90. 133 figure 20 on the top side. The low from a few weeks back was 132.90 or something. So we're just trading a range. So all the day-to-day machinations, we're still trading the range. That's a really important thing to remember. Depending on which way the news flow goes, and vol has gone through the roof. So if you were trading options and you had a bought options 2 weeks ago when I said this is just better off to trade options, you wouldn't have been getting flicked backwards and forwards, although I know some of you actually made some good money on sterling. You wouldn't have been getting flicked backwards and forwards by the headlines. And you wouldn't be making money now because vol's gone through the roof. And that impacts on the price of options. Anyway, what am I now? Just the range, folks, the range. What do I think is going to happen? Frankly, I don't know. It would be ridiculous for me to pretend I know. If I had to bet, surely the British Parliament's going to come down on the side of the people and business. I don't know. Anyway, and I know that might mean different things to different people. Aussie. Right, this is the weekly Aussie. I've been talking about this rounding for weeks now, haven't I? I've been talking about the Kiwi leading us, and then the Kiwi took out 68.50 last week. And then we had that big surge. So what have we got? We never got that retracement I was looking for. We never got that move back, which is always something you've got to take into account. Another thing that David Rosenberg said, please watch that 8-minute video, and persist. When he starts talking about Canada, persist, because there's some important bits after that. He also said that our views colour our forecast. Now, that's really important. I know I'm 8.5 minutes in. That's really important. This is why you don't hear me saying, oh, the big call. I think that Euro's going to 93, which in time I think it will. And you hear me say, and possibly 103, or my medium-term view is 108. The reason that I don't, hold that view and just bang and bang and bang is because it doesn't help us. Because we are trading day to day and week to week. And if I suddenly put it out there that I think the Aussie's going to go to 81 cents, then that's going to colour, I'm going to own that. And it really does colour people's forecasts. So what am I saying? I'm saying when you watch these videos each day, let's just look at the charts. Let's look at the MACD, let's look at the Fibonacci's, let's look at the trend lines, and let's figure out what that tells us on a probability basis based on my experience using these tools. That's what I'm doing every day. Anyway, what do we got here? We are on the cusp of a big break, potentially to 76 cents, I think. Now, we're already 3 cents off the low, aren't we? We've come down today, or it's under pressure today, because of what happened between Mike Pence and President Xi at APEC and the belligerence, and people are worried that the trade deal can't happen now. I would say the trade deal is not going to happen at G20 anyway, but doing a trade deal in this hegemonic battle that the US and China are in. You know, the US and Australia are redoing the base at Manus. Australia, New Zealand, and the US are paying for PNG to get electrified. You know, that is separate to trade. That is absolutely separate to trade. It's part of the same battle, but it's separate to trade. So it doesn't mean you can't do a trade deal just because we've got this Thucydides, this hegemonic battle going on between China and the US. That's something different. For the Aussie, it's gone vertical, which is always a warning. Any pullback, I think, is going to be well supported. Fair value, 73 cents at the moment. Unless stocks bail, collapse, that kind of thing, I think this should be okay. Potentially, that's a head, that's a shoulder, which would suggest 76. At the moment, though, my target's just this boring garden variety, as usual, 38.2% retracement, 74.40. Right, CAD. The CAD and the Singapore dollar are really good examples of why I watch these and I don't get too excited. This is why I use a cross-market basis. I told you it was going to be a long one. I'm going to hurry up. Right, so what have we got? There's two trend lines here. It's clear people are watching this one and not that one. So what have we got? We've got it stalling. We've got dollar CAD down. It's up a tiny bit today. But what have we got? We've effectively got an inability to break higher. So for me, that suggests at least a test back to 130.80, which is only 70 points away. But if it was to slip through there, then you would get things would start to look wobbly. From the Singapore dollar's point of view, if I'm consistent in my, well, if things can't go up, then they go back to the 38.2% retracement, then I'm looking for 135.5, roughly. Aren't I? Unless or until that breaks. Now, that would be a massive break. We take out the highs of that range. That is a massive, massive, massive break and tells us something about the US dollar. Unless or until we do, then, you know, this 15 EMA has been pretty good. The 30 becomes the next attractor, right? 136.34. And if that breaks, then we're down at 135.40. So keep an eye on those. Now, the Kiwi, gone a bit vertical for mine. The PPI was shot through the roof, though. This morning, it was well north of expectations. So, where's the Kiwi look like? Well, it's broken 68.5. So any move back towards sort of 68.30, 68.50 looks like support now. In my note to myself, my where is it? Can you see it? Yeah, there it is. My weekly scan that I do. I have written 70 cents, I think, for the Kiwi. Kiwi is, of the 30-odd markets I do, the Kiwi's number 6. And I've breakout target 69.70 to 70.24. And that's not that far away now, is it, really, when you think about it? So 70 cents looks like it's in the frame for the Kiwi. Now, quick, let's get moving to gold. Gold was up. Gold's holding that trend line. Gold's found support 11.95 where it was supposed to last week. If gold takes out that high, it's running towards $1,300. That's all I'm going to say. Support remains there. The MACD is contracting. Copper's up at 280. Can you believe it? It could be under pressure if this trade battle goes south again. It's a financialized asset. The market is relatively tight, all things considered, but it's been moving with expectations about global growth and about trade. If we get some sort of deal, or we get a sense that there's some sort of deal that what Mike Pence said is actually different to what President Trump's saying, then we can see this roar. It's got to get through to 280, right? It's at 279 now. Gets through 280, 286.5 to 287. If it can break through that, it's 293. Then we're talking about a completely different game. As it stands at the moment, though, that is a pretty tough market to trade because it's up and it's down. But the levels are 264, 286. That's the range intra week, and a break either side would be big news. Where's my oil charts? I know I didn't talk about silver. So this is WTI. So WTI is actually broken and held below. That's actually quite a bearish outlook on the weeklies. If you look at it, pardon me, on the dailies, have a look at the written version of Markets Morning. If you look at it on the dailies, you can see that it could rally. It could easily rally back to $60, and then maybe even 63. So let's say that, you know, the last line of resistance, the 61.8, and don't forget 38.2 and 61.8 are interchangeable. It just depends on which way, whether I go from there to there or there to there, as to whether MT4 draws them as 61.50, 38 or 38.50, 61. So don't worry too much about that. But it held above the 50, the 38.2 of that move, which is the 61.8% retracement. As long as it holds above there, it looks okay. But it's got to get back up above this week. If I find that trend line, 58 odd, to start to rebuild. But as long as it holds above last week's low, it looks okay. Once last week's low breaks, and you're talking about a full round trip of where's my Brent? There it is, of where we're going. So look, what Brent looks kind of different. It didn't have the same sort of trend line. Guess we could draw that for you, but see that's nowhere near it. And if you put that there like that, then you've more got that it's broken back down, and so support will come in about $61. Remember I talked about that. For the moment, we just got to wait and see. Last week's lows, I'm just going to respect the chance of a bounce, $3, $4, $5 in both of those, while last week's lows hold below last week's lows. Then I'm talking about a different kettle of fish. S&P 500, right? So on a daily basis, you can kind of see a two shoulders and a head. Sorry, but it's inverse. So that's why I'm doing it that way. Have a look, but 28, 23 to 25 on the S&P 500. On a weekly basis, consolidating. If it took out 2 weeks back's high, which, surprise, surprise, is, 27.12. 28.17, so 28.23 is the number I keep saying because that was the high over there. Unless or until it does that, it's still in a kind of a consolidation range. If I have a look at the NASDAQ, if I can find the NASDAQ, I'm not sure if I've got the NASDAQ in this little chart pack here, though. It does not. There it is. It doesn't look as strong. Uptrend broken, obviously. Hasn't kind of rallied as much. It needs to break up and through that trend line there, 7,200. I don't think it's going to happen. I think the NASDAQ can diverge from the S&P, although it would be a weight on the S&P. But we'll keep an eye on it, see how we're going. I don't hold that view overly strongly. For the local market, you can see the support there. It's an ugly bearish engulfing week last week, a seriously ugly week. The structure of our market looks terrible when you think about it in those terms. So what I've written today is that it needs to hold 56.90. And it closed at 57.39 on Friday. If it gets below 56.90, then it's a shot duck and it's back at the lows, so 90 points. And if it falls through that 85 to figure on 5,500, then it can be under intense pressure. The DAX. So if I look outside the S&P, to be honest with you, when I did my scan on the weekend, when I looked everything outside the S&P, none of them look strong. They all need the S&P to do well. If the S&P does not do well, then they are short ducks. 11.1 to 11 is the key support here. 11.7 is the resistance. If it can get back above 11.7, then it's back in this range and it can rally maybe even to 12.2. But, that's rounding, holding, 1, 2, 3, fourth week of, holding. So we'll keep an eye on that one for the DAX. A bit like the Aussie market, it moved earlier. And that's it. So I'll just do Bitcoin, which is under pressure, 5,500. If you just shrink that down, that break of 6,000, or in some manner, if I do this, $873, the long-term target for Bitcoin. In the meantime, though, 3,400 is where this, this shorter version, from there down to here, up 50% odd, and then the break is 3,400. But long term, it might even slip under $1,000. Anyway, that's it from me on behalf of myself and those of us who are part of McKenna Macro. I want to wish you all the best today. Good luck, great trading. Have a good day. Don't forget it's Thanksgiving, so the back end is going to get quite thin. And watch out for John Williams tonight. I think he's going to be really, really important. I'll catch you tomorrow. Bye for now.